Gurmeet Chadha is here on the show with us. Gurmeet, hi, afternoon. Good to have you on the show. As we close in on the financial year, Gurmeet, what's been the biggest learning that you've had personally from the markets?
I think the biggest learning is that never ignore valuations, I think. And the tide can turn very quickly. Sometimes you tend to ignore that in a good time and start discounting, high growth rates for longer. Big order books without realizing orders can be delayed, can have execution risk, giving high multiples to ideas which you think can't be disrupted. When everything is cyclical and reverts to mean is what market basically keeps telling you. It's like a pendulum. If it goes to one extreme, it has to figure out to come back and then go to the other. So but overall, I think probably now ending slightly on a better note. It's not as bad as it was in February and in first week of March. And I think the macros are improving. And I think hopefully we should have a better financial year than what we have had in last 3 to 6 months.
Some amount of sanity, Gurmeet, now that it's already kicked in, how far from the next leap, which was the peak of 2004, or do you think we're not going to get back to those levels in any hurry?
No, I don't think so. We should spend time predicting that because eventually market will make again, a higher low and a higher high, which is what it has been doing for last two decades. I've been in markets, so I think instead of focusing on that, I think the focus should be what can do better from here rather than focusing time on market levels. Nobody can really guess it. But I think, as I said, there are few pockets which are, I say, looking better now. Valuations have become reasonable, whether those are financials. I think the basic high frequency indicators, whether it's your power demand, whether it's your toll collection, advanced tax collection, and even the finance minister yesterday spoke about that economic indicators pointing to a better quarter. And if we can get back to, 7.5% kind of a GDP growth, and maybe double digit earnings for next quarter, I think we should be good. I think earnings are the key. And I think if we can demonstrate sequential improvement in Q4, I think the market probably should stabilize.
Point taken. Thank you so much for that, Gurmeet. But we'll come back to you. Before that, let's actually get the news that the cabinet has approved a PLI scheme for electronics manufacturing. Prakash is here with all the details on that particular front. Prakash, what are you picking up from your sources?
Yes, it's an important development coming in as we are learning from our sources that the Union Cabinet meeting has just concluded, and it has given its nod to a PLI scheme for manufacturing of electronic components. That's an important development coming in. As you are aware that the previous scheme, the tenure of the previous scheme has been completed, and therefore a separate proposal had been sent. A separate proposal was sent by the Ministry of Electronics, and therefore it was considered today by the Union Cabinet. And as per the proposal, what we are learning from our sources, the Cabinet has given its nod to approximately 24,000 crore to 27,000 crore for this scheme. Some critical components such as displays, batteries, camera modules, printed circuit boards are going to be manufactured under this scheme, and that will cover entire value chain of the electronic manufacturing. So the government's objective is very clear: to cut down import and then become self-reliant going forward as far as electronic manufacturing is concerned. As per the initial estimates, the government believes that they'll receive more than 50,000 crore investments under this scheme. It's a very, very crucial development coming in, especially at a time where the government is expanding its domestic manufacturing base in various sectors. And today, Union Cabinet has approved PLI scheme for electronic manufacturing. So there is a press conference scheduled at 4 p.m. today, where the formal announcement will be made by the government.
Thank you so much for that, Prakash, for getting us those details when it comes to the PLI scheme, especially for electronics manufacturing. You have Keynes as under pressure. Let's take a look at what Dixon is doing, as well as Amber Enterprises as well. And these counters have actually drifted lower over the last couple of minutes. Coming to you, Gurmeet, I wanted to understand how you gauging this entire space. EMS, one of these narrative stocks at one point in time, making a comeback, struggling to make a comeback. What's your take?
Yeah, I think the valuations are still high despite correction from the highs. If you look at Dixon, we hold Dixon in our portfolio, but and we've been beneficiary of the move it has seen in last 3 odd years. But don't see much room to add further. I think a lot of good news is in the price. I would probably want to see the value addition having an impact in electronic component segment in their margins. I think what we are seeing is they are low single digit, and if we can demonstrate slight improvement in margin in different verticals, I think that to me would be a trigger for whether to look at the stock or not. Otherwise, you're already at three-digit earning multiple. So it's kind of capturing all good news. Amber also, to a large extent, again, richly valued, serves RECs. And if you see of top 10 AC makers, eight of them are their clients, including Daikin, Voltas, Panasonic, Blue Star, etc. And now they're obviously diversifying. So I think you want to probably see any improvement in margin. And obviously, PLI related news can have a bit of an impact in terms of the quantum for a few days, but in terms of incremental addition, I think you're better off with some of the white good players, pure play, where the valuations are still more reasonable compared to the EMS names.
So that's the take coming in on some of these EMS spaces where the valuation still looks a bit, tad bit elevated. But remember that we're coming to the end of the financial year, the month as well. And come next week, we will have the auto sales coming, trickling in. In fact, we have Abhishek standing by to tell us exactly what are we penciling in when it comes to the motor sales or auto sales for the month of March.
Auto OEMs will report their monthly volumes in the next week. On a broader note, the numbers are expected to be mixed bag. CV segment is expected to report a muted performance largely because of the lower fleet utilization levels and limited retail push from the OEM side. In the PV segment, the retails were muted, but it is expected to report a higher single digit kind of a growth in the volumes, mainly because of the M&M's outperformance and some inventory buildup ahead of the price hike from April onwards. In the two-wheeler segment, OBD2 norms will get implemented from the April 1st, and we expect that the mass market segment players would align their inventories in line with the demand. Eicher Motor is expected to outperform the two-wheeler peg. Tractor segment is expected to outperform the overall automobile volumes in the month of March. It is expected to report a double-digit kind of a growth, mainly because of the favorable base and the inventory build-up ahead of the season. Going forward, retailers are looking towards the retail sales during the upcoming festive seasons like Gudi Padwa and the Chaitra Navaratri.
Right. Okay, that's the take coming in on autos right now. But Gurmeet, wanted to get your sense, the point that you were earlier making, that the time is to focus on actually catching the stocks right after the correction. So what's looking interesting to you?
So, Asha, I think we discussed banks a couple of weeks back. I think Bank Nifty has done well. I think with RBI policy on 9th, I expect the further rate cut. I think you'll also see more liquidity infusion. Also, RBI is changing the regulatory tightening framework. Where when they were going after gold-based NBFCs, they were going after personal loans, unsecured personal loans. They're worried about the stress building up the unsecured parts. I think there's a bit of a change there, not getting as micro, which I think in general is good for the industry. We like gold-based NBFCs also. I think HFCs also will come in focus. So other than banks, this is a pocket we like. We like this recycling theme. I think that's where probably the opportunity is more long term, whether it is water, whether it is air, whether it is plastic recycling. You call it circular economy, where you extend the life cycle of a particular product by recycling it, refurbishing it, and or changing the end use of the particular product. So that's the space we like. We have Vatek Vaba, we have Ganesh Ecospan in the portfolio. We're looking at few more names in air purification as well. We like the consumer discretionary, especially travel and tourism play. So we have Interglobe in the portfolio. We're looking at some hotel names. We added some ITC hotels when the stock was down quite a bit. And we are looking at very selective, defense names now with the massive surge happening now in Europe and overall under Trump 2.0. I think yeah, this is a bit of a mini industrial revolution, if I may call it. It's what it is triggering in terms of look at Sweden, look at France, look at Germany. You'll see a lot of countries upping the defense and the domestic spending work related to their own infra.
Very interesting, actually, that stock list that you've actually spoken about, Gurmeet. And what actually struck in all of that was ITC hotels. It's been a while that we've heard another hotel name apart from Indian hotels making it to the list, the buy list. Niresh, what's your take on ITC hotels? How is this one looking on the charts?
So not much data technically, but what we've seen after the listing, the stock did see a lot of volume. So that post-listing selling is over, and now it becomes a buy on dips going forward.
That's the take coming in ITC hotels. Short and sweet, given the fact that yes, there's paucity of data when you talk about ITC hotels. But Kunal, what's your BTST ideas for our viewers?
So I'll go with two buy calls. The first one which I would be suggesting would be about Bajaj Housing Finance. That's a chart which is looking extremely attractive, especially after yesterday's price volume breakout move for the stock. Would look out for targets in the range of 131. Stop loss could be kept at 117. And the second would be about Piramal Pharma. That's also another chart which is looking fairly attractive, trading above the 220 plus mark, a breakout point, flag formation on the daily time frame for Piramal Pharma. Would look out for targets in the range of 232. Stop loss at 218.
Interesting call there. Piramal Pharma, long after it's really come on at least Kunal and Naresh's radar. But Naresh, what about your BTST ideas?
So first would be a buy on Nykaa. The stock is on verge of a breakout, stop loss at 175, target price of 185. Second is a buy on ITC, risk reward trade here. Tried to give a breakout, stop loss at 407, target price of 418.
That is Nykaa coming back on Naresh's radar along with ITC. What's your take coming in on some of these platform companies? You did give a list of stocks that you are liking, actually, Gurmeet. But what about the platform companies? How are you looking at those names like Nykaa, or for the matter of fact, CDSL, PB Fintech, if I can add to it, or Paytm?
So, we basically look at this in two categories. One is the financial platform plays, which is, even a depository or an exchange, something like a CAMS, which is more a play on financialization. And then you have the consumption related platform plays, where we have Zomato, in the portfolio. I think near term, I think because of the intense competition in e-commerce, you'll probably see more cash burn in especially in adding dark stores. In fact, Zomato has said advanced 1,000 dark stores to be added actually now in 25 instead of 26. So maybe 1 or 2 quarters you will see that kind of a burn. I really don't call it a burn. In my view, that's more a capex you do because you're setting up more stores. That's adding more capacity actually. So at some point of time, I think the market is trying to price that in, and if the results are slightly better, I think sure. But I think it's a good story over a medium to long term. So I don't know what makes the cut, whether it is Zomato, Swiggy, or Zepto, but you should have some e-commerce play in the portfolio. We are looking at Nykaa now. Haven't really added it because as women participation picks up in workforce, the spend, especially the Gen Z spend, first pocket is travel and tourism, and the second one is basically BPC, and that's where probably you see more spends coming in. So we are looking at that as well, and we have a very small exposure at PB Fintech as well.
Right, okay. That's the take coming in on some of those platform plays. But Naresh, what's your sense at Zomato? Seems like a bit of a consolidation phase that the stock has hit in, right?
So the stock was earlier holding in a range of say 240 to 300, and now the range has shifted say roughly to 190, 200 on the downside, 230, 240 on the upside. And overall, there is a big support around the 180 mark. This is where it roughly 170, 180 is where it topped out after listing. And there was a cluster of this zones also back in the start of 2024. So I would expect 170, 180 should be a major support, and that should be a very good entry point for the medium term for the stock.
That's the take coming in on Zomato and how that one is looking on the charts at this point in time. But Kunal, I just wanted to get your view, especially on the markets as a whole, given the fact that we are ending the week. It's not been a bad week over the last 2 weeks, isn't it?
It's not been a bad week when you look at this in the context of the last 3 to 4 weeks for the markets. But yes, of course, I think the expectation was that the markets, after yesterday's price recovery, would probably want to see a follow-through up move. We had a good start, to the indices in the first half today. A lot many stocks, large caps, mid caps, were seeing a follow-through up move. But I think midway somewhere we managed to come back into a selling spree for individual stocks. My sense is that this could be that routine profit booking which happens into the FI closing, the fiscal year closing. So I think that could be the major reason for that. Hopefully, I think once the market resumes the next week on 1st of April, that's where I would believe that if we manage to pick up pace, if we manage to come back above 23,800 mark, that could be a second round of a breakout for the indices.
Gurmeet, while it's important to know what's going to work, it's also important to know what you're not going to touch in the financial year ahead, or at least 1 quarter or so. Do you think sectors like IT, some of those globally export auto plays and auto anchors as well, they are best left avoided?
I think we'll have some clarity, Asha, on 2nd of once we cross that mark a few days. I also think a lot of negative is in the price, especially for IT and auto to an extent. I think market is extrapolating the impact a Tesla would have or a BYD would have, and that impact will come over a course of time. And a lot of the price damage has happened, whether it is M&M or Tata Motors or even some of the auto ancillaries. It's a very complex play. Things are not as simple, and we don't know how much of the tariffs will hold and what will be the reciprocal tariffs. And so I think at some point of time, the price would give you an opportunity. I still think that auto, especially two-wheelers and four-wheelers, there is a structural story over the long term. But yes, in the near term, I agree with you. Let events pass. There are and the entire market right now, there are a lot of bargains. You don't have to really do that. Secondly, balance the portfolio. Don't ignore fixed income. Don't ignore gold. I think what market does, it teaches you every now and then to have a very balanced asset allocation. Look at how gold has done last year or so, and look at the long-term returns. If you see 10, 15-year returns, I think the long-term returns are actually catching up with equity. There's hardly a 1% difference now, with equity being 13, 14% and gold being around 12.5. And I think there is scope for bonds. Look at the supply, the government borrowing plan, which government announced. The net supply in this year is actually lesser than 2023. I've seen this after a while, which means that, fiscally speaking, the supply would be less. And once the rate cut cycle starts to revive growth, you could make serious money on a duration play in a bond fund as well. I've been talking about bonds for a while. So have a more balanced play. And most importantly, as a lot of people say, it's a tougher year. So reset your expectations. If you play for 12, 15%, I think there are a lot of opportunities. If you get aggressive, I mean, there's a good chance you might lose capital.
Coming in on some of the sectors, if you look at the financial year gone by, yes, you're seeing some sort of an up move in the mid cap index. 7% higher is what they're shutting shop for this financial year. Also, you have the small cap index that's traded high above over 5%. And surprise, surprise, you have BSE and Dock among the top gainers in this financial year, despite the correction that we've actually seen in the defense counters. Dock has managed to hold on to good gains, at least in this financial year. Today is a tad bit lower in trade today. On that note, I believe we have Snehi also, who's standing by to actually wrap the day for us. But before that, thank you so much, Gurmeet, Naresh, as well as Kunal, for being part of the show, as well as taking us through all the market strategy. Over to you, Snehi.